Soaring inflation may be pushing the world economy into recession. 0.75% interest rate hike by the Federal Reserve is the largest increase in nearly 3 decades, aims to counter rampant inflation, which hit a new 12-month peak of 8.6% in May. The Fed's 2 earlier rate hikes in 2022 have done little to slow inflation so far, and economics and financial experts now worry high prices, higher mortgage rates and more expensive credit could usher in a recession. The Federal Reserve on Tuesday analyzed 3 economic models to determine the odds of a recession, with mixed conclusions. 2 models showed low risk, but a broader analysis of inflation and unemployment indicators predicts a rise in jobless numbers over the next year, which could lead to a recession. The report also notes that, historically, elevated inflation and low unemployment have preceded recessions. To assess whether we're in a recession, economic experts have their eyes on gross domestic product, or GDP, the value of all goods and services produced within a country during a specific period, which is a key metric used to gauge economic growth and recessions. In the first 3 months of 2022, the U.S. GDP dropped by 1.4%. When GDP falls during 2 quarters back-to-back, technically the country is in a recession. With mounting anxiety about an impending recession in the U.S., you may be concerned, or at least a little curious, about what this may mean for your finances. My So Money podcast audience recently sent in a number of questions related to recessions about how best to prepare, save, invest and generally make smart money moves in these uncertain times. Here's some guidance to help navigate through what is a difficult financial period for many of us. It's always helpful to go back and review recession outcomes so that we can manage expectations. While every recession varies in terms of length, severity and consequences, we tend to see more layoffs during economic downturns. Accessing the market for credit may also become harder and banks could be slower to lend because they're worried about default rates. If the Federal Reserve continues to raise rates to clamp down on inflation, then we might see an increase in borrowing costs. So, even if you qualify for a loan or credit card, the interest rate may be higher than it was in the prior year. We're already seeing this in the mortgage markets where the average rate on a 30-year fixed mortgage is over 5%, the highest level since 2009. The silver lining in some recessions is that, as rates go up and inflation cools, prices on goods and services fall and our personal savings rates increase, depending, of course, on the labor market and wages. We may also see an uptick in entrepreneurship, as we saw in 2009 with the Great Recession, as the newly unemployed often seek ways to turn a small business idea into reality. With stocks in a downward spiral for weeks, many want to know how a recession could impact their long-term investments. Should you stop investing? The short answer is, no. At least, not if you can help it. Avoid panicking and cashing out just because you can't stomach the volatility or watch the down arrows. My advice is to avoid making knee-jerk reactions. This may be a good time to review your investments to be sure that you're well diversified. If you suddenly experience a change in your appetite for risk for whatever reason, talk it through with a financial expert to determine if your portfolio needs adjusting. In the Great Recession, unemployment reached 10%, and it took an average of 8 to 9 months for those out of work to secure a new job. So now could be the time to review your emergency fund if you think there's a shortfall. If you won't be able to cover a minimum of 6 to 9 months' worth of expenses, aim to accelerate your savings by cutting back on spending or generating some extra money. If you're self-employed and worried about a possible downturn in your industry or a loss of clients, explore new revenue streams. Aim to bulk your cash reserves, as well. If previous recessions taught us anything, it's that having cash unlocks choices and leads to more control in a challenging time. As the Federal Reserve continues to raise interest rates to curb inflation, adjustable interest rates may increase and make monthly payments more expensive. Reach out to your lenders and card issuers to learn about low-interest credit options. See if you can refinance or consolidate debts to a single fixed-rate loan. In past recessions, some banks were hesitant to lend as often as they did in normal times. This can be troubling if your business relies on credit to expand, or if you need a mortgage to buy a house. It's time to pay close attention to your credit score, which is a huge factor in a bank's decision. The higher your score, the better your chances of qualifying and getting the best rates.